That is the closing bell on Wall Street, and now it's market domination overtime. We are giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Brook DiPalma joins us now with the latest market action. Brooke.
Good afternoon, Josh. We're seeing all three major indices close now with a bit of mixed picture. We do have the Dow moving higher, but the Nasdaq and the S&P 500 falling, especially after a few moments ago, we did see President Trump take to Truth Social to share this. He said on Truth Social that he believes China purposefully is not buying our soybeans and causing difficulty for our soybean farmers is an economically hostile act. Now, he went on to say that, as an example, we can easily produce cooking oil ourselves, so we do not need to purchase it from China. And based upon that Truth Social, in the last few minutes of today's trading session, we did see that flip in reversal when it comes to the Nasdaq. As you can see right here, the Nasdaq was also moving lower, but the S&P 500 specifically, you can see right here towards the close, we did see that reversal from the momentum that we're gaining in the middle of the day after Jerome Powell had spoke around noon. Now, in Jerome Powell's comment, he indicated that the Federal Reserve will focus on inflation and employment. He did say some deterioration within employment is extending. And so we saw that reversal within the S&P 500 around noon, tick to the upside. And then based upon that Truth Social tweet, or rather post, we did see that reversal. And so now we have the S&P 500, that index move lower, down nearly 0.2% at the close. We also have the Nasdaq. That index really just did not flip to the upside today at all. It's now closing down nearly 0.8%, but the Dow was able to reverse and hold on to some momentum, once again flipping around noon and now closing higher, up about 0.4%. But I do want to take a closer look, because what we are seeing here is a bit of a mixed picture when it comes to semiconductor stocks. We have AMD. That stock moved higher and it now closed up about 0.8% based upon this deal that Oracle is going to invest and buy AI chips from AMD. That stock holding on to momentum in the close. Meanwhile, Broadcom really paring back the gains that it's got on Monday after it announced a deal with OpenAI. That stock now down at the close, down about 3.5%. And Nvidia, this stock just was not able to hold on to the momentum that it had earlier on Monday, and it did stay, mostly in the red today and did close lower, down about 4.4% at the close. But what I find really interesting here is if you take a look at transport stocks, it's a different picture here, different market that we're looking at here, because United, well, that company is expected to report earnings after market close on Wednesday, and it was able to move higher, up about 4% ahead of that, and that's after Delta really reported a strong report last week. That stock up more than 8% over the past 5 days. Taking a look, though, at the broader picture here, the Nasdaq, mostly a bit of a mixed picture with Nvidia, Microsoft, Amazon, and Meta down today. Apple and Google moving higher. So once again, taking a step back, a bit of a mixed picture here with the Dow able to hold on to the momentum, but the Nasdaq and S&P 500 moving lower at the close.
All right, thank you, Brooke. Well, steady consumer spending, a strong labor market, and the Fed's insurance cuts all point to continued growth, according to our next guest. Despite resilience, could we see a recession? Let's welcome in here Dryden Pence, Pence Capital Management CIO. Dryden, always great to see you, especially on set. I want to get your take on the U.S. economy. First, I do want to get your take on these headlines, U.S.-China trade tensions, Dryden. It's interesting because I think a lot of investors had thought, things are going okay. The two sides are talking. To some extent, I thought it actually kind of moved off the radar. Now it feels like those tensions very much back on the radar. You got the new post from the president saying he believes China purposefully not buying U.S. soybeans. That's an economically hostile act. Says we're considering terminating business with China having to do with cooking oil and other elements of trade as retribution. You're an investor. You actually have to put money to work in this market. How do you navigate all this?
Well, I think the first thing we look at is you've got to kind of look deep and long and recognize that there's some fundamental issues that are underlying all of this. And the reality is that China's trade with us is 2.3% of their economy. They don't trade with us, they go into recession. Our trade with them is about 0.5%. So if you look at this battle and this war that's going back and forth, it's an economic war. And the point of the matter is we have a much stronger hand. They need us more than we need them, period, end of story, full stop. And if you kind of step away from this, you recognize that what we're seeing is a lot of noise, a lot of words around a battle, but in the general war, we're probably going to win.
So what do you, as an investor, do you say to yourself, I'm going to see these posts, I'm going to see these headlines, but I'm going to look through it, it's noise, and just I'll focus on earnings?
Exactly. Because you focus on earnings, you take a look at the fundamentals. You know, a lot of this, I call it the frazzled cat syndrome. The market's it's true, the market's at kind of a high. You get any piece of noise, everybody goes crazy, they're upside down on the ceiling, they panic, they overreact. And so that's one thing we've been saying for a long time, buy chips on dips. And be in the situation that when people are overreacting to these things, back up, look at the fundamentals, look at the earnings, and then make sure that's what's driving your.
Do you think, in some sense, is this market kind of coiled or positioned to overreact because market concentration, because of valuation?
Absolutely.
Yeah.
I mean, because particularly when you get to the top, when the pricing is a little bit ahead of the earnings, and we're looking at, people kind of wonder what's next. But we're going to see earnings probably be very good as they come out. We just started today, right? And then we're going to continue to see earnings in the next couple of weeks. And I think those are going to be pretty good. And we're going to be looking forward to predictions are overall for the S&P 500. Earnings are going to be up 10 to 12% next year. So, you know, earnings at an all-time high means markets are at an all-time high. And I think people have to just kind of recognize when we get to these peaky moments, folks overreact. Sometimes people are irrational and they overreact. And then for us, we look at that as an opportunity.
Let me ask you about the U.S. economy. You say, you say no recession in sight. What explains that resilience in your opinion?
Sure.
What gives you the confidence in that resilience?
Three things. First of all, we're still in the early stages of burning off all of the COVID. You know, we put $5.4 trillion into this economy in 1 year, 5 years ago. That's more money than we put in World War II. The multiplier effect on the stimulus of World War II went all the way to 1974. We're just 5 years after what happened with COVID. So underneath this economy, you still have all of that stimulus and the multiplier effect that's still working. So that's the first thing. The second thing is you have labor productivity at an all-time high. That's helping drive things forward. The third thing is you have a cycle where the Fed is beginning to lower interest rates. So you have a generally good economic stimulus level. You have the Fed with plenty of dry powder. It's not like 7 years ago where they were at zero, right? So they've got room to stimulate if they need to. And then you have this moment where labor productivity is up. We've added 7 million more workers in the last 5 years than we had before. That's the entire labor force of Illinois. That's the equivalent of $3.1 trillion of additional income. That's like growing France over the last 5 years. So you have all of these big underlying things putting a base under this economy. Yeah, we're going from a torrid pace, which is like, if you're driving a car at 90 miles an hour, you slow down to 50, you feel like you're going 0, but you're really moving 5 times faster than you can walk. So we're moving from a torrid pace to a sustainable pace. And that sustainable pace is going to be pretty good. And you have a Fed lowering cycle, and you have labor markets are in balance.
So let me ask you this, I'll get you out on this. Your clients come to you, they say, okay, economy's hanging in there, earnings are solid, Jay Powell's cutting. What's the risk? What am I worried about? What do you tell them?
You're always worried about some anomalous black swan event, global risk. You have, a war goes off, somebody gets really crazy and does something. Those are the things that you have to worry about, but you always have those risks. But in terms of fundamental risk, I don't see a lot of fundamental risk in the economy so long as we're kind of moving things through deliberately. You could have a huge policy mistake, and that's Washington, but other than that, I don't see a lot of things to be worried about. But you have to recognize we are slowing down. But it's to move to sustainable pace, not torrid.
Dryden, always good to see you, especially on set. Thank you, sir.
Absolutely. Thanks for having me.
Coming up, if you experience sticker shock when it comes to buying a new car, you're not alone, and some fresh data supports how expensive it truly is. We'll give you the details coming right up. Sticker shock is creeping up for car buyers. According to Kelley Blue Book, the average new vehicle price in America crossing $50,000 for the first time ever. For more, we're bringing in Yahoo Finance senior autos reporter Praz Sumeranian. Praz.
Yeah, KBB, they track these things, and I saw this headline cross. I knew this was something we had to talk about. So, Aaron Keating over there, the head analyst, was talking about how She's been expecting it to break 50, as many of the people in the industry have, and it did. It crossed $50,008, $80, sorry, in September, the first time, and that's up 3.6% year over year, right? But it's also up 2.1% sequentially from August. In month over month, it went up 2%, right? The price of a new car. So what's going on here, right? So obviously we have tariffs, right? Tariffs are happening, slowly pushing the cost of cars up. We have just inflation in general of the car parts. We've seen, things like supply chain crunches, and that's still happening. But also, it's EVs. EVs, generally speaking, are a higher priced vehicle. About 58,000 was the average ATP, apparently, according to KBB. And so what happens is you have a lot of EVs, people buying EVs because of the tax credit, that pushes that average price up. So, are we going to expect prices to come back down? Not so fast, according to KBB. They said, hey, car prices are always going up. This is just more of the same. And it's going to keep on going on. If you're a person who wants a $20,000 car, those days are over. You got to go to the used market, and that's where you live.
Who's buying these cars, by the way? I mean, I would assume, is it relatively wealthier households?
Yeah, Keating from KBB said basically it's quote unquote wealthier households are driving the current auto market for new cars because they have access to capital, access to attractive loan rates a lot of people don't have, right? And that sort of props up that higher in the market. So it's interesting because we're talking about an industry that has 15, 16 million cars sold a year, right? Million. You're telling me there's that many rich people in this country that are buying cars? No, not necessarily. But what's going to happen with people who are more price conscious people are taking out 72, 84-month loans, right? Yeah. They're pushing that out, expanding that out to get that monthly payment. That's all that matters. The monthly payment. Can you hit that? We talked about this, right?
Sure did.
That's the most important thing. So that's what they want to hit. The automakers like Ford and GM are going to try to shoehorn you into that longer payment set to get you into that better payment term for the month. But then again, the cost of the car is going up more and more and more.
All right, thank you, Pras. Appreciate it. Will 2026 be a year of global growth, or is the story less optimistic? Our Jennifer Schonberger sat down with the chief economist at the IMF for more.
You're out with your new World Economic Outlook, and in that report, you say that growth over the next year is going to be dimmed. How much of that is being driven by tariffs versus other forces? What are those other forces? And if not for tariffs, would we be seeing a more sanguine global outlook?
Yeah, so let me maybe put it in perspective for you and your audience for a second. So back in April, when the tariffs erupted on the scene, and we were scrambling and trying to put our projections together, we projected that there would be a downgrade in global growth. It would be from modest to significant. And so 6 months later, with our new round of projection, we're basically saying, well, the good news is we're at the modest end of the range. So we're projecting growth at 3.2% for this year, 3.1% for next year. And 3.2%, by the way, is the growth rate that we had a year ago for 2025. So you might say, oh, well, then it's unchanged. So does it mean that the tariffs had no effect? And, no. That would be both premature and incorrect. It would be premature because there have been a lot of things that are still going to happen with the tariffs. We're going to talk about some of them, but the effective tariff rate that the U.S. has right now is close to 20%. It's still very high. And incorrect because there have been a number of things that have happened since April that can also help us understand why we're at the modest end of the range. And among those things, I would list the fact that first, the tariffs themselves have been coming down a bit. Many countries have negotiated trade deals, there have been exemptions. So all of these things have kind of lowered the temperature. The second is the private sector has responded. We've had huge amounts of front-loading of imports in the first half of the year, rerouting of supply chains, trying to adapt to this new environment, and that brings some resilience. And third, we're seeing a number of other drivers, not trade-related, that are also helping support the global economy. If you're looking at the US, well, we're in the middle of an AI-related investment surge, and that's certainly propping up activity, investment, consumption activity, all of that is propped up. If you look at other countries, you have fiscal policy that's been playing a role. In China, in Germany, it's going to come and play a role in 2026, even in the US with the budget bill from July. And then, last point, financial conditions. Financial conditions have remained very accommodating in 2025. The dollar is depreciated in the first part of the year. It's stabilized after June, but it's depreciated quite a bit between January and June. And we see equity valuations are very, very high. Credit spreads are very tight. So financial conditions have also helped absorb that shock. So the bottom line is the shock is there. We're feeling its effects. It's going to continue. but it's been offset by other things that have helped keep the global economy buoyant.
Speaking of the tariff shock, tensions between the U.S. and China have recently boiled higher. President Trump has threatened ratcheting up tariffs on the world's second largest economy by 100%. He has said that China has become hostile now that they have imposed further export controls on rare earth metals, or rare earth exports, I should say, a sticking point that we thought had been overcome a couple months ago. The president sort of dialing back a little bit of that rhetoric over the weekend, the administration talking with China. But then just this morning, Beijing moving to effectively ban Chinese companies from doing business with U.S. subsidiaries of a South Korean shipbuilding giant. So how is the IMF viewing this? Does this create downside risks to global growth? And if we were to see tariffs ratchet higher to the level of 100%, does that tip the global economy into recession?
Well, it's certainly a stark reminder that we live in a world where this type of trade tensions can erupt anytime. And the trade policy uncertainty associated with that is extremely elevated. And we see that in our measures of policy uncertainty. They remain very, very high, even if we've had some normalization, some trade deals and exemptions. So yes, the picture, this is part of the risks that we're facing. Now, this is something that we are looking at carefully, of course, both the actual developments. The situation is very fluid, so we have no idea where this will land. And I think at this point, the important thing is to think that our baseline, 3.2% this year, 3.1% next year, is the right reference point, if you want. But around that, there is a risk. There is a risk that the trade tensions might flare up, and that might materialize. We've tried to assess not the specifics of, the most recent announcements between the U.S. and China, but we've tried to assess what are the broader risks coming from an eruption of trade tensions. So we did a downside scenario in our report where we looked at what would happen if tariffs are increased, if supply chains are dislocated, not the exact assumptions of what might represent the current developments. And the impact on the global economy is significant, 0.3 percentage point very easily on global output for next year. So instead of saying 3.1%, we could easily be at 2.8%. And so that would be quite a big shock.
So far, the impact of tariffs on rewiring supply chains and inflation has been muted. But in your report, you say that the muted impact from tariffs so far could reflect a delay in higher prices and costs being passed through. So have we yet to really see the full impact of tariffs?
So first, I would separate what we see on the supply chains and what we see on the prices. On the supply chains, we're already seeing quite a bit of rewiring. If you look at the bilateral trade between the U.S. and China, it's down a lot. If you look at the trade between China and other Asian countries or with Europe, it's up a lot. If you look at imports from the U.S. side, much less from China, but much more from Asia, much more from Europe. So these supply chains, they've already started moving. Now, when we look at the prices, what we see is the following. First, the import prices, which is the price at which the exporters are selling when the goods get to the dock, get to U.S. soil. These have not changed. What that means is the exporters, on the whole, are not absorbing the tariff. The tariff is being paid on the U.S. side. It's being paid by the importers on the U.S. side and potentially by the customers when it gets to retail price. We don't see yet a huge increase in retail price. We see some, especially in the very heavily tariffed goods, we see some evidence that these prices start to inch up, but not by a huge amount. So, what that suggests is it's in the middle. The importers are absorbing that in their margins. They're not going to do that forever. So eventually they will start passing that through. And that's what we have in our baseline, that this pass-through of tariffs into retail prices will continue in the US. And that's one of the reasons why when we look at US inflation, we're expected to remain elevated. A year ago, we're expecting we would now be at 2%, back at central bank target. We're at 2.7, and we're expecting that it will remain high next year as well.
So when President Trump says that other countries are going to pay for U.S. tariffs, that's not what you're seeing right now when you look at core inflation on goods in the U.S. versus the rest of the world.
As of now, when we're looking at import prices, these import prices have not declined. So this is not being paid by foreign exporters.
I do want to ask you about immigration. we have seen immigration come down markedly in the first half of this year. And in your report, you reference research that if U.S. immigration policies were to remain in place, we could see anywhere from the tune of 0.3 percentage point to 0.7 percentage point impact on GDP to the downside per year. Is that right?
Well, so the impact of immigration here, let me sort of take a step back and think about what it's doing on the labor market. So what we have is a situation where we have much less immigration in terms of the flows, and we're also seeing a decline in the share of foreign-born workers in the labor force in the US. And that might be because some of the already here foreign-born workers decide that they are not going to try to report to work, or they actually might move elsewhere. And so that's a significant reduction in labor supply. Now, that reduction in labor supply, it's also a negative supply shock. It's a bit like the tariff. It's reducing the amount that the economy can produce. It's going to put pressure on wages or on prices. So it's something that is, reducing output and increasing inflation pressures. Now, what's been happening right now is that reduction in labor supply has been met by a reduction in labor demand. And so overall, we haven't seen a deterioration in the labor market.
Time now for To Watch Wednesday, October 15th. We're going to start off on the earnings front here. More big banks reporting on Wednesday, including Bank of America and Morgan Stanley. We're also going to hear from the semiconductor sector. ASML announced results for the third quarter before the markets open. Analysts expecting sales to come in strong for Q3 and could match last quarter, keeping it on track to meet its goal of growing 15% in 2025. Taking a look at the Federal Reserve, we're going to be getting another round of commentary from Fed officials throughout the day on Wednesday. This is coming after comments from Fed Chair Jerome Powell on Tuesday. Powell saying that downside risk to employment appeared to have risen, paving the way for potentially more rate cuts in 2025. And speaking of the Federal Reserve, the Fed's Beige Book is coming out on Wednesday, one of the few major economic reports that is not affected by the government shutdown. Investors will be watching closely for any clues about labor data and whether inflation could be cooling or heating up. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. And I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.